Welcome back to Investing Talk Podcast. The question on that table today is one we've received repeatedly in our comments. Is Ouster a good time to buy now? We're doing an exploration of their situation today. Ouster operates in the complex, high-stakes LiDAR sensor market, and we're really zeroing in on two main things: their long, difficult path to profitability and, well, their recent, frankly, stunning competitive position shifts. Before we begin, just a quick reminder, please remember to subscribe, like, and comment. Really helps us out. And if you have a specific company you want us to look into next, please drop us a comment below. We absolutely prioritize those requests. Our mission today is pretty crucial because we have this fundamental conflict in our source material. It's quite striking. We've got two very different narratives right here. One, painting a picture of deep fundamental weakness, mostly based on, older public filings, and another highlighting recent, almost unbelievable explosive momentum. So we need to unpack both sides carefully to understand the full risk-reward profile for you, the investor.
Yeah, what's fascinating here is just the shared difference in perspective and, critically, the timeline of the data we're looking at. It's almost night and day. We are looking at a classic scenario where, historical financial health and this recent operational turnaround are pulling the investment decision in completely opposite directions. So to really get the necessary context, I think we have to start with the hard financial reality outlined in their earlier 2024 reports.
Okay, let's start there. We definitely need that bearish foundation first. So when we look at the figures reported in the latest annual 10K, which for listeners is that big comprehensive financial statement companies file each year, Ouster reported revenue of $100.2 million for the year ending 2024. On the surface, that's solid revenue in what's still a pretty niche market.
It is, but, and this is the big but, if we connect this to the bigger picture, that revenue was achieved at a tremendous cost. Ouster remained deeply unprofitable. The net loss for 2024 was approximately $68.5 million, just to put that into perspective for you. For every dollar of revenue they generated, they were losing about 68 cents after all the operating expenses were factored in. That's significant.
And the real structural problem seemed to be the gross margin, right? That metric, which basically shows how much profit they make on the actual sale of the sensors before accounting for overhead like R&D or sales.
Yeah.
Well, it was stuck way down in the single digits, sometimes even negative territory across several quarters in 2024.
Right. And that kind of margin pressure, it really speaks to two things: either deep structural costs in manufacturing, maybe component sourcing, or, I suspect more likely in the LiDAR space, just brutal price competition. When margins are that low, you inevitably see a significant cash drain. Ouster confirmed continued negative operating cash flow, meaning they were burning about $45 million in 2024 alone just to keep the lights on and operations running.
That trend is highly worrisome, especially when you look at how thin the balance sheet was back then. The cash balance at the end of 2024 was only $79.1 million.
Exactly. And when you combine that level of cash burn, $45 million a year, with only about $79 million in the bank, well, it raises an immediate and, frankly, an existential question about liquidity risk. They were quickly approaching a point where they would need massive further financing just to survive.
And that kind of financing usually comes at a cost, doesn't it? Typically shareholder dilution.
Precisely. So, based solely on these historical fundamentals, the huge burn rate, the low cash, those terrible margins, the overall consensus rating for Ouster back then was historically weak. We're talking somewhere around a 3 out of 10, which really made it suitable only for the most speculative short-term traders, That was the established reality heading into 2025.
Okay, now, everyone hold that thought about the 310 rating, because we absolutely need to pivot now to the sources detailing 2025. This is where the story shifts so dramatically it almost makes those 2024 figures feel like ancient history. Ouster apparently demonstrated extremely robust momentum, particularly starting in the first quarter of 2025.
The whole narrative just flips, which is, why the stock market got so excited earlier this year. In Q1 2025, revenue hit $33 million. Okay, that's a solid 26% year-over-year increase. But the real story, the thing that caught everyone's eye, was the focus on operational efficiency. Cost control suddenly started paying these huge dividends.
You're talking about that incredible turnaround in margins. The gross margin improved substantially, jumping all the way up to 41% on a GAAP basis, and an even healthier 46% when you look at it non-GAAP.
Yeah.
Could you quickly clarify that difference for our listeners?
Sure. So GAAP refers to generally accepted accounting principles. Those are the standard official numbers everyone has to report. Non-GAAP, on the other hand, often adjusts for things like, say, stock-based compensation or maybe certain amortization costs. It tries to give a clearer picture of the operational performance of the core business itself. And a jump like that, from negative or single digits to over 40%, Well, that suggests maybe better component pricing, much tighter manufacturing, or perhaps a better mix of higher margin industrial sales versus maybe lower margin auto contracts. Something changed structurally.
Okay, and as a direct result of that new efficiency, the net loss narrowed significantly too, down to $22 million for the quarter, much better than the run rate we saw in 2024.
Yes, but what stands out to me most, honestly, is the liquidity solution they found. Remember that kind of terrifying 2024 figure of just $79.1 million in cash? Well, recent information shows a strong, rapid increase in cash and investments. It's quite remarkable. They apparently reached $171 million after Q1 2025, and then dramatically climbed again to $229 million as of September 2025.
That is a staggering difference. I mean, we went from a company potentially facing a liquidity crisis within maybe a year or so to one sitting on hundreds of millions in the bank. That completely changes the game, doesn't it?
It absolutely does. It essentially buys them significant runway and dramatically changes that immediate liquidity risk assessment compared to the 2024 data. The pressure is off for now. But, and this is crucial, we have to ask ourselves, is that 41% gap margin sustainable? Or was Q1 maybe a non-recurring spike, perhaps due to inventory adjustments, or an unusually large high-margin contract? Because if they slip back to, say, 10 or 15% margins, that $229 million will start burning a lot faster than people think.
That's a really critical point. Assuming they can maintain that efficiency, looking ahead, Ouster projected Q3 2025 revenue somewhere between $35 and $38 million. So that signals they expect sustained expansion, tied largely to growth in key verticals like automotive and warehouse automation.
Right. These are the spaces they often refer to as physical AI. LiDAR, for those maybe less familiar, it's essentially the eyes for autonomous systems. It uses lasers to create these detailed 3D maps of the world, which is absolutely essential for self-driving cars, but also for drones and robots moving goods around in a warehouse, for example.
Okay, so this momentum is clearly what's fueled the recent excitement around the stock. But we do need to talk about the market itself. The LiDAR sensor space is, well, it's incredibly crowded. You've got intense price competition against established players like Luminar Technologies, Innoviz, and increasingly some very aggressive Chinese entrants pushing prices down.
Yeah, the crowded nature of the market is sort of a permanent headwind, isn't it? Their recent merger with Velodyne definitely helped consolidate things a bit, boosted their patent portfolio and market share. But achieving sustained competitive advantage remains really uncertain when everyone seems to be driving prices down relentlessly just to win those big automotive contracts.
Okay, and this brings us to maybe the biggest conflict in our sources, and frankly the most confusing part of this entire analysis for me. The stock price data itself. It doesn't even seem to agree.
I agree. This is where the different analyst reports we looked at just refuse to align. It's quite jarring.
Exactly. So one technical analysis we saw suggests the stock has recently traded somewhere between $5.20 and $8.50 per share. And it noted bearish long-term signals because the price was below the critical 200-day moving average, which that report pegged around $7.40.
Okay, so that's one picture. But then another completely independent source states that Ouster's stock price reached a high of $27.83 as of September 26, 2025. And that source linked it directly to the strong liquidity position, that $229 million we just discussed.
So how do you reconcile a bearish signal around $7.40 with a massive recent high near 28 cents? That's nearly a 300% difference. Is this just an issue of data lag between reports, or is one fundamentally flawed? Or is something else going on?
Well, it certainly speaks to the extreme level of volatility here, and frankly, the nature of trading in these pre-profit growth stocks. It's quite likely, I think, that the $27.83 number was maybe a peak achieved during perhaps a short squeeze or just a moment of hyper-speculation right after one of their cash-raising announcements hit the news, while the, say, $5-8 range perhaps represents the consolidation phase after that initial excitement cooled down a bit. Regardless of the specific current price, though, the technical setup is clearly characterized by way above average volatility. That's entirely common for tech stocks in a highly speculative sector like LiDAR.
All right, volatility aside, let's look at who probably knows the company best, the insiders. We have information on insider activity observed between May and September 2025. What does that tell us?
Right. This is always a vital metric for any potential investor to watch. The Form 4 filings, which track insider trades, indicate there has been continued insider selling through something in Rule 144 transactions, and this involves multiple insiders.
Can you quickly explain what a Rule 144 transaction is?
Sure. It's basically a mechanism that allows company affiliates and insiders to sell restricted stock they hold into the open market. Often, these sales are part of pre-planned trading plans, set up in advance. But the key here is really twofold. One, they're selling, consistently not buying. And two, even though these might be planned liquidations rather than, say, panic selling, the fact remains there has been no significant insider buying observed recently. None at all. And this suggests that the internal leadership, the people running the company, they are not accumulating shares themselves, despite the recent positive momentum narrative and that huge run-up in the stock price we saw. That lack of conviction from within, well, it has to be seen as a bit of a red flag, doesn't it?
Yeah, it does raise questions. Meanwhile, what about the retail crowd? Social sentiment seems a bit cautious.
It's noted as mixed to negative, generally. I think retail investors, they remember the pain of the 2024 narrative, the dilution, the falling stock price. Their skepticism seems focused mainly on the lack of, sustainable profitability and the ongoing dilution risk that's always been necessary for fundraising in the past. They've kind of been burned before, and I think they want more proof that this 41% margin is actually here to stay before they fully jump back in with both feet.
Okay, so putting all this together, what does this all mean for the immediate future? Since we've established that the company seems to sit at this really critical inflection point, there must be some short-term events that could drive significant movement and maybe help clarify if that, say, $27 valuation was a sustainable signal or just a quick speculative spike.
Absolutely. The next quarter, really the next few months, it hinges entirely on execution against their growth targets and proving that Q1 wasn't a fluke. We have, I think, 3 specific dates or periods to watch that will either confirm the bull case or potentially resurrect the bear case.
Okay, what's first?
First up, the Q3 2025 earnings release. That's expected around December 10th, 2025. This is the big one. This report absolutely must confirm or deny the continued margin improvement and that growth trajectory they projected, 35-38 NEMA revenue. If margins fall back significantly, say below 20%, the stock will likely suffer badly.
Makes sense. What's number 2?
Second, we have the institutional 13F filings. Those are expected around November 15th, 2025. These are the quarterly reports where institutions, hedge funds, major asset managers, pension funds disclose their holdings. So this will reveal whether large, sophisticated players are actually accumulating Ouster stock, maybe validating the turnaround story, or if they're perhaps liquidating positions. It could confirm or deny some of that market chatter about big cash inflows.
Okay. And third,
keep an eye on ETF rebalancing, specifically for things like the Russell indices and maybe some global AI-focused exchange-traded funds. That often happens around October 15th, 2025. These rebalancings can trigger forced buys or sells based purely on the fund mandates and index rules, which could cause high volatility and large institutional flows either in or out, sometimes regardless of Ouster's immediate fundamentals.
right, just mechanical buying or selling pressure.
Exactly. Now, beyond those known dates, there are also some more speculative catalysts making the rounds in the market that you should probably be aware of. Rumors persist, for example, of additional strategic partnerships, maybe in autonomous vehicles or warehouse robotics, that physical AI space we mentioned. These could accelerate adoption and provide immediate revenue boosts if announced.
Yeah, I've also heard some of that market chatter suggesting large institutional buys might be revealed in those November 13 F filings, potentially confirming where some of that massive cash inflow came from recently. Maybe a major fund initiating a large position.
That's possible. And finally, there's some speculation that Ouster may be targeting small AI software companies to acquire. The thinking there is it could accelerate feature development for its LiDAR-based industrial solutions, sort of moving them up the value chain from just selling hardware to providing more comprehensive sensing solutions. So if we try to connect this all back to the bigger picture for you, the listener, Ouster sits at this extreme inflection point. It really does. The historical 2024 data warns clearly of high liquidity risk, of dilution, backing that original week 310 rating. You can't ignore that history.
Yet the 2025 data shows this significant, really dramatic improvement in margins, and especially the cash position, which fueled that massive run-up in the stock price earlier. So the investment decision seems to depend entirely on whether you, the investor, trust that the recent Q1 improvement is actually a sustainable structural trend, meaning they have truly solved their cost and efficiency problems, or if it was merely a temporary blip in a notoriously cash-hungry and competitive sector.
Exactly. And that cash position, that new $229 million firewall, that is what is giving them the breathing room, the runway they so desperately needed a year ago. But, runway is only useful if you were actually headed towards profitability, not if you're simply postponing the inevitable crash.
So what does this all mean at the end of the day? Well, the company's long-term success seems fundamentally tied to the pace of adoption for LiDAR technology itself, both in automotive particularly ADs, advanced driver assistance systems, and in those broader industrial applications. Which leads us to our final provocative thought for you today. Given the current high volatility and this massively conflicting financial data we've unpacked, the real decision for an investor isn't just about Ouster's underlying technology, which seems solid. It's more about whether you believe the company can successfully transition from that aggressive growth spending phase to generating consistent positive cash flow before its substantial new liquidity cushion runs out. And that makes the upcoming December earnings report arguably the most critical data point of the entire year for this stock. Thank you for joining us for this exploration of the sources on Ouster. We certainly hope this analysis helps you make a more informed decision.